Hello, everyone, and welcome to the Sound Financial Group podcast. My name is Paul Adams. I'm the founder and CEO of Sound Financial Group, and I am not joined by Corey Shepard today. Corey is out doing wonderful, amazing things with his family and unable to join us today. But you have me, and today you also have my unwilling co-host, Dave Ramsey. That's right. I decided to do another little Dave Ramsey clip because of one of his videos that came across my radar. Now, the video itself, we're not going to get into all of the things that Dave speaks to in this video. But what I want to point out is the level of confidence and condescension that comes along with an influencer, in this case, a financial entertainer like Dave Ramsey. The reason I say not financial advisor, totally unlicensed, and does not have the ability to offer financial advice. It's the reason why the beginning and the ends of each of his shows say you should consult an advisor. And as Corey and I always say on this show, you should consult an advisor or coach. Now, for some of you, that advisor or coach is us. If you're listening and we are not your advisor or coach, you're more than welcome to reach out to us. But the big deal is you shouldn't take anything from a podcast or from a clip and say, this is what I should run with. You want to then test those things with somebody else. That's the importance of an advisor or coach in your life and in your finances. Now, I don't want to forget, this is super important, guys. I'm going to spend time on it now going forward because I do not want to forget. It is really, really important to us as a channel to subscribe. Most of you watching this right now are not subscribed. It means the world. If you find any reason to comment, I'll give you a few things to comment about. Comment below. Be sure to like the video or be sure to dislike the video if you don't like it. I'll take anything, but be sure to subscribe, share it with somebody else, like the video, and let's get in to listening to this person make a phone call into Dave Ramsey. And we're going to see how it goes from slightly passive aggressive to full-blown condescension and no willingness to explain to somebody what it is they're saying. I think because of the zealotry we talked about before, where somebody has made a decision 15 years ago is no longer revisiting that decision. They're just recounting the decision they already made long ago, often evidenced by the unwillingness to provide any support for the point that they're making. So let's jump right in.
Welcome to the Ramsey Show. How can we help?
Hey, Dave. Glad to talk to you.
You too, man.
Enjoy your show.
Thank you.
All right. I am calling in response to a video I saw recently that you claimed infinite banking concept was a scam and actually got quite pissed off about it. So I do not agree with that and certain points that you made in that video. And I have set up a policy for my son when he was 1 year old. He's 5 now.
I'm sorry.
Right there, that's where Dave says, I'm sorry. I'm sorry you did something generous for your son to try to set him up for a financial future, etc. And that dismissive, passive-aggressive thing, which you'll see in a moment, the guy thinks he's referring to his son being 5 years old, not this policy, but it's neither here nor there. The passive-aggressiveness will pass shortly. It's going to go to full-blown condescending aggressiveness.
Say that again?
I said, I'm sorry.
Yeah, so am I sometimes. No. So I set that policy up for him when he was 1 year old. It has a $500,000 face value. We pay $5,373 a year for 13 years.
Now, that's going to be important. $5,373 for 13 years. We're going to come back to that in a moment.
And it's paid up at that point. There's a few points that I wanted to discuss that I just didn't agree with. Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you. and you only get the face value paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value.
Okay. So we just said dividend reinvestment is not cash value. Now, that's not the main point that we're going to pick on in our conversation today, but this is my point that I want to make. Dividend reinvestment is not cash value. That's the equivalent of saying the cash that you give to the teller is not a bank deposit, because later it becomes a bank deposit after she puts it in the drawer and types it in the computer. Like, that's how silly that statement is. Now, Dave often sets up these straw man arguments. Both he straw mans, makes it as easy as possible to approve of his strategies, and then he takes the most negative aspects of any other strategy out there that he doesn't like, and he uses only the weakest parts of that, or totally untrue statements like, if you own a whole life policy from a mutual company and it pays you a dividend, you are getting additional cash value. It is that simple. Now, the reason he's going to talk about in a moment, it does go to purchase paid up additions. Now, what he doesn't go on to explain is a paid up addition on a whole life policy. When you get a dividend, then it goes back into your cash value and death benefit. Your death benefit grows a little, because it would be the equivalent of, imagine walking through a Walmart and there's just like a little kiosk and it says life insurance. And you walked up and said, hey, here's my age, here's my health, here's $50. What does that get me? And they look up on this mortality table and they say, oh, that'll buy you an $85 death benefit you never have to pay for again. You say, great, leave your $50 behind and you take the insurance policy with you. That's happening every year with the purchase of the dividends, growing the cash value and the death benefit. Why? Because Section 7702 of the IRS code says that's how you keep cash values tax-free. So it's not being done the way Dave talks about it, almost like they're buying a new insurance policy every year, which is insane to even like propose, but he's doing it so that people, either he doesn't fully understand it or he's intentionally trying to confuse his audience so that they don't understand something like this well enough to use it prudently. Just jump right back in.
Dividend reinvestment is because you have a mutual company and the policyholders are the owners of the company. And so the profits from the company come to the policyholder and they use that to buy paid up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
Incorrect. It is not the same as buying more insurance with your overpayment. They design the policies to be more robust. So here's how I'd have you think about it. I had a mentor of mine teach this a long time ago. If you imagine the George Washington Bridge in New York, I don't know exactly, but it's something like it takes 4 lanes, each direction, 2 levels. So basically you have 16 lanes of traffic, and it's designed to be able to have it full of totally packed 18-wheelers, both directions during a Category 5 hurricane, so that that bridge doesn't fall with bad weather or heavy loads. It is intentionally over-constructed. When we acquire a whole life policy, it's also intentionally over-constructed. But there's a difference. If you were to drive over that bridge at 3 a.m. one day when it's just you and, I don't know, 20 other cars, you don't benefit from the over-engineering. But on a whole life policy, you do benefit from the over-engineering because that leaves profits for a mutual company. Mutual company does not have stockholders. In fact, the board of a mutual company has to act with the fiduciary interest of the policyholders, and as a result, the policyholders get dividends. Stock companies also pay dividends, but you don't see Dave Ramsey running around saying, well, they had you overpay for your insurance and then they sent those damn dividends out to the stockholders. One, that would be a dumb thing to say. Dave, it's equally not as smart to say that it's a bad thing that mutual companies pay back to their policyholders. There is no greater relationship. And the only problem is there are not enough mutual companies left because enough CEOs were very, very greedy and decided to take these long-standing mutual companies, convert them to publicly traded companies, and at the same time pocket a truckload of money. But he doesn't beat up on that. It's like terrible mutual companies even utilize whole life insurance. Here we go.
But it still works out to be having a cash value much greater than the $69,849 we put into it.
But the actual cash value, not the paid up additions.
All right. So he wants to somehow separate the actual cash value from the cash value that was accumulated with paid up additions. It all shows up in the cash value column. There's not like there is a value of dividend additions. But even if that is dividend additions, that would be like me saying about the mutual fund he promotes is, well, Dave, if I took my interest out every year, I never get that big compounding. Again, that would be a ridiculous thing to say. So for him to say, well, yeah, it grows as long as you keep rolling the dividends back in. Now, I'm being a jerk to Dave. Why? He's in the arena. This guy calling him does not deserve to be treated like a jerk. Dave is out there having built a tremendous career. He's worth, probably between $50 and $100 million, which I don't look at his pockets. I don't care how much money he's worth. But in a world where, I don't know, there's some conversation about maybe the wealthy need to be a little bit more sensitive, Dave is kind of blowing that thing as he just absolutely has zero empathy for this guy. Now, here's my theory. If somebody called our show and was misinformed about something, I'm not going at him. I'm coming alongside him. For those of you that have worked with our firm, you'll know that's what we do also. Dave has to do this because it helps his ratings. So rather than come alongside people and maybe have 15% less views on his videos, he prefers to act this way. And I'm just going to call it out. Because what he's doing, rather than educating or coaching somebody, is he's spending the entire time not only making them wrong, but going out of the way to have the way he treats this person somehow make him look better or smarter. And his folks, co-hosts that share the show with him, don't ever really get a chance to push back on that, to say, maybe you shouldn't do it that way. So let's get back in and see where this devolves to.
The actual cash value dies with you.
No, because
yes, it does.
Okay, but
okay. Now this is another one I need to speak to. See, there's so many fallacies coming at us so quick and expressed with the greatest amount of authority and confidence, and wrong. So when he says the cash value dies with you, that's cute. But it's just not part of the contract. If, let's say, I bought a life insurance policy that started with a base face amount of $500,000, that's whole life. And then I own it a really long time. And sometime later, I have $1.2 million of cash value and $2.4 million worth of death benefit. If I die, my family gets $2.4 million. Now, you could say, oh, your cash value dies with you. Well, that's true. That's the straw man. It sounds cute, sounds pithy, sounds like they're ripping you off. When in reality, what they did is they gave you access. My cash value is almost like my access to the death benefit before I die. It's much more accurate to say it's the part of the death benefit I can access and pull out and put back in while I'm alive, the cash value, than it is to say the cash value dies with me. So if the cash value dies with me, actually, here's a great one. Here's just a dead, flat, Dave, you are wrong as all get out. Because the cash value died with me on that policy, my family would only get 1.2. No, there is the cash value and then the net amount at risk. And the cash value grows over time, and so does the death benefit. So when Dave says these things, he's being pithy and cute, wildly inaccurate. I had no idea how often I was going to have to stop this video. The thing I wanted is like 7 minutes in. I was really going to disprove. I don't think we're even going to have time to get to it today because I can't get, I'm only 2 minutes and 23 seconds into this, and I've already had to dispel 3 or 4 things that we could objectively look up on Investopedia and show that Dave is wrong. But we'll get to it when we get to it. May have a continuation next week with Corey, who may pull me back, and I may not be as agitated as I appear to be today. But let's keep going.
But your death benefit is larger than your cash value. So for me, I looked at it
because you bought more insurance.
No, he didn't buy more insurance. The dividends paid out, and in order to keep them tax-free, according to Section 7702 of the IRS Code, he had to deploy them back into paid-up additions, which did increase his death benefit, but also kept that cash value growing with no taxation on it every year. Okay, Dave, please continue.
You know what a paid-up addition is? A paid-up addition is buying additional insurance.
I understand.
That's why you're getting more at death. Not because you got your cash value, but because you used your policy dividends to buy additional insurance.
Right, but
that's like saying the reason your mutual fund's so much bigger is you compounded your returns. And if you didn't compound your returns, that wouldn't happen. True. Also, Dave, if I bought a bunch of real estate and then the following year just sold it real fast at 50% less than what I paid for it, I would lose money also. Like, of course, you can do things that don't work, but he's not suggesting that what people do is buy whole life insurance and then just take their dividends. Not even close. He's literally just saying your money is not in cash value and it's not growing because it's dividends. Okay.
That's different than getting your cash value. If you took those policy dividends and went and bought a term insurance policy for $100,000, well, you'd get $100,000.
Okay, this is a whole new level of like, I mean, that would be, I'm not even going to try to make a comparison here. What he just said is, if you took your dividend from your whole life policy and then you bought a term policy, you'd have more insurance. Yeah. Well, you would, but it'd be temporary insurance. It would expire. And oh, by the way, your dividend will get chewed up over time if you don't die within the term, which according to Penn State, less than 0.5% of all term insurance policies result in a claim. Incredibly profitable for the insurance company. And yes, you'd have more, but why would you own a whole life and buy a term insurance policy with the dividend from the whole life? Man, I wish I could like somehow insert and see if Dave could actually answer these questions. I don't think he could. He's used to being able to talk over people. I've never seen him debate anybody of any worth. If there is somebody who's an enormous Dave Ramsey fan and wants to debate, then please reach out to us, info@sfgwa.com. Same place you'd reach out if you wanted to meet with one of our advisors and just hear about our philosophy and see if we're a good fit for you. Again, it's info@sfgwa.com, or go to our website and get one of our tremendous white papers. Both Corey and I have written one. You can do that at sfgwa.com. That's Sound Financial Group, sfgwa.com. All right, let's go back to Dave.
But that's not your cash value.
Well, I have a term policy.
I know, but you missed my point. Okay, you're talking about you use the policy dividends. You use the money they send to you because you're in a mutual company to buy additional insurance.
Yes, paid-up additions,
Yeah. If you buy a term policy on the side for $100,000 instead with that same money, you would get $100,000 more than your face value, but that's not your cash value. That's additional insurance. They're different.
Right, they are different. In term, you don't have cash value to borrow against.
I'm aware of that, but your point was that you don't lose the cash value, and my point is 100% of the time, by definition, you lose the cash value.
100% of the time, by definition, at your death, your cash value blossoms into a much bigger, totally tax-free amount to make sure that your family has the greatest likelihood of having a good life going beyond you as the breadwinner passing on. Giving your children a fighting chance at having a decent college, giving your spouse a chance to be able to raise the kids and not immediately have to get remarried because of financial stress and circumstances. Like it is equally accurate to say your cash value turns into double when you die as it is to say you lose your cash value when you die. That is the straw man. This is the kind of misinformation out in the marketplace. I've heard people restate it, and then I say, help me understand this. And then they realize they just took something Dave said and they don't actually know it. And I would counter, Dave has some narrative about why it's okay that he's talking the way he is to people and with these levels of inaccuracies, but you get the point. He likes having these debates with somebody that's not well equipped. I almost promise you, if I'd called into his show and had this conversation with him, it wouldn't have aired. And it wouldn't have aired because there would be somebody on the other side of the equation being able to go, yes, that's a straw man argument, Dave. That's just inaccurate. This is the function of how cash value and death benefit work. Remember, unlicensed financial entertainer. If you were an insurance agent, I think in most states you would lose your license if you tried to talk about life insurance the way Dave is.
You.
Okay. So as I said, tit for tat, if he lives to be 80, I'm looking at the readout here.
Uh-huh.
If say he only lives to be 80, okay?
All right.
The cash value will be worth about $2 million,
yeah.
But the payout for the death benefit will be $2.6 million. So, okay, technically, yes.
So what the caller just expressed is this policy that when the child got it at 1, had a $500,000 death benefit, is projected to grow up to $2.7 million by the time he's 80 years old, or 2.6, whatever he just said. Okay, that's what this fella just expressed about this policy, and it would have some large cash value also at that age 80. Now, if you're not aware, whole life insurance functions more like a CD or U.S. Treasury than it does equity investments. So cash value and whole life insurance only goes up each year, can't go down, and can go up a little faster or slower depending on how good the dividends are from the company that issued it, which often is tied to long-term interest rates. So like right now, insurance companies are doing the best to buy these higher yield bonds because those will pay dividends to their policyholders for years to come as they lock in some of these higher interest treasury notes, et cetera, and then be able to turn that into good use of their reserves used to pay claims, and the excess interest on those reserves get paid out to the policyholders via dividends.
Well, you take the cash, you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about because you.
Okay, now that right there is just dead wrong. You are not going to have term insurance on an 80-year-old bought with dividends from a whole life policy. Like this whole idea of your dividends by term insurance is like, it doesn't even make sense. If this was a group of financial people all around talking and Dave Ramsey said that, it would be like one of those record scratches in the room.
Get a better buy on the insurance than you're getting with this rip-off whole life crap.
Yes, you would get a high, but you wouldn't be able.
Now, here's how I experience a ripoff. He says this whole life rip-off crap. Now, when someone rips me off, what they're doing is taking money from me and giving me nothing back. Or a ripoff could be, you took money from me and gave me part of it back. But the caller just said it's going to grow to millions of dollars for their child at age 80, and of course it's growing much more than, or alongside that all the way as you'd project it on a curve. That's not a ripoff. That is his way to try to demonize something so that he doesn't have to disagree with it. If he just calls it a ripoff, then nobody really asks for his math, etc. And you'll see why it's not a good idea to ask for his math here in just a moment. And in a few minutes here, we're going to wrap up on that point.
To use it throughout your life as your own bank. And
well,
I think that's
okay. But here's the thing.
The big thing
that's a side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement. Well, let's just do a little present value calculation on what you put in for a baby. $5,000 a year for 13 years. Do you know what that would be in a mutual fund? At age 88? It would be $25 million, dude.
All right. We just had Dave do some math. So let us do a little bit of this math with him. So what Dave just said was this guy was going to be able to put, I'm even going to try to be more accurate, $5,373 a year for 13 years. And I had to mess around because, of course, like you might imagine, Dave doesn't say what interest rate he's using. Why? Because then people could double check his math and see that he was wrong. It took me working around different interest rates. I've never heard him use 7.5% before, but maybe now he's trying to make amends for all the years that he said 12% unabated. Like you could go get a mutual fund that would dependably do 12, which you can't. And maybe he's doing like 10% return, which would be like 100% equity portfolio, all stocks, and then 7.5% after tax. Like that's my best guess of what he's doing. Because what it says is, yep, the person have $120,000 in 13 years. Then he said 88 years old. The gentleman said his son was 1 when they got the policy, which would be 74 more years of compounding. Is that right? No, 64 more years. Oh, guys, we got to redo the math on Mr. Ramsey here. So that's only 11 million. So let's see what happens if we give 8% rate of return. Nope, that's 15 million. How high of a rate of return is Dave going to use to get to his 25 million? Well, that's more than 10 or less than 10. 9? Okay, we'll stick with 9. 9 gets us to 28.8 million. Now, keep in mind, that's beyond 100% equity portfolio and beyond what you could do in any sort of fixed income portfolio. So he's basically taking an asset that is treated by banks as AAA reserve capital, like that top tier capital that they can lend against, and he is comparing it to what would be one of the most aggressive equity portfolios out there. And so this is my point in our conversation today. Yes, I want you to notice what a condescending guy Dave is. He's just awfully condescending to people that call his show, unless they're people that 100% accept his doctrine for how to plan. It treats you so good. Even if you have some misunderstandings, as long as you're doing his debt-free scream, as long as you're calling your show and not asking questions that are critical. So that's important to know that if you're listening to his show, he's not taking any critical feedback. He's not taking any critical feedback from his listeners, and he's not taking any critical feedback from anybody on his staff, because anybody on his staff with a calculator would know he just made a comparison of whole life insurance, one of the safest things, like the financial planning board and all of that, like classifies it the same as CDs at a bank, and yet turns around and compares it to a full-on stock market investment, the kind, which, by the way, stock market investments are great. We do lots of them for our clients. We manage a lot of money. But he's making that comparison of an investment that will never go down in value to an investment that just during COVID probably went down 30, 40% in a matter of 8 weeks. So he's willing to make that comparison because he's doing it so far out in the future. And the point he made right after this point, which we don't have time for today, but where he ends up going next is, well, you can borrow a lot of money out of those investments. Yes. But when you take money out of the stock market, you are losing the return that the stock market had at that time. Number one. Number two, maybe your investment opportunity was going to be right when the market was down 40%. So you might effectively be able to take it out, but practically you're not going to. And lastly, this is giving his child a different kind of gift. This is something that the person calling in doesn't talk about, but it's really a neat gift to give your children life insurance that protects their insurability their entire life, that puts them in the position that no matter what happens to them as they're a teenager in sports or something else, if something messes up their ability to acquire insurance, they have an insurance policy that will protect them and their family to some extent. So that if parents have that surplus, they already have their own life insurance properly squared away, it can be a great gift. Now, today, I didn't make any commentary on the infinite banking philosophy. It was just curious that this man called saying in the part of whole life insurance, which we didn't even get 5 minutes into the video, so this will give us a good part 2. We ended about 4 minutes and 50 seconds. So we're going to pick up there next time. But the thing to take away is the guy got to his first question and just already getting so hammered, I don't think they're going to get around to talking about infinite banking at all. And while infinite banking is a technique to use, for those of you who've been exposed to it, I'll say one thing just so you know that how I think about it. I think that too often infinite banking can lead to people consuming more than they would have and not creating the amount of wealth that they originally intended to with the strategy. So with that, Corey should be back with us next week. We'll pick up on a little more of this video with Dave. We'll look forward to seeing you then next week. Please don't forget, it means the world to us for you to like, subscribe, comment below on what you'd like to hear next, or put it in our podcast reviews, what you'd like to hear next, because we're here to help you design and build a good life.